Exchange traded funds, or ETFs, are our preferred way to invest. We use them to build a global investment portfolio with huge diversification for close to zero cost. But picking the right ETF for your portfolio is not as straightforward as it could be.
In this video, we're going to give you our top tips for picking the best ETFs for your portfolio. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
To invest in ETFs, you will need an investment platform. For the widest selection, then a great place to invest is through the platform Interactive Investor. We'll put a link down below.
Alternatively, for a smaller ETF range but with zero commissions, then Freetrade is worth checking out. New customers who use our link will even get a free stock worth up to £200. We'll put the link to the Money Unshackled offers page in the description below.
Tip number 1. Know what index it's tracking. Don't rely on the name. Don't just pick an ETF based on its name. ETF names can be very misleading and often don't invest in what you think they might. To start with, you will hopefully find a bit of info on the objective of the ETF and the benchmark on the ETF provider's website.
What we often do then is quickly Google the index and take a look at the index provider's own documentation. From the names, you would think that these two ETFs probably contain the same underlying stocks.
It turns out that MSCI group Korea with emerging markets, but FTSE allocated to Asia Pacific. You'll never know this unless you deep dive into the ETFs and their respective indexes. Where you can rely on the name is the part that references the fund provider. For instance, we trust Vanguard, iShares, SPDR as good ETF providers with strong records and low fees.
Tip number 2, keep fees low. Fees are one of the main drags on an investment fund's performance. Unfortunately, finding out the true cost of an ETF is not as easy as it should be. The main fee is called the ongoing charges figure and is published almost everywhere you look, with the best place being the provider's own site.
But the OCF is not the only fee that you need to look out for. The next biggie is transaction costs that the ETF incurs. These are usually hard to find, but they should be on the fund provider's website if you look hard enough. Your investment platform should also provide them at the point of buying the fund in some form of cost disclosure document.
Looking at this cost document from Interactive Investor for the Vanguard FTSE 250 ETF, we can see that the OCF is just 0.1%, but it has transaction costs of 0.16%. Remember that these transaction costs are specific to the ETF and nothing to do with the platform you use to invest through. That's a scary hidden cost. For this particular fund, the fee is 160% higher than what you are led to believe.
The fees don't end there. Every time you trade an ETF and stocks, you'll have to pay the bid-offer spread. The bid price is the highest price you can sell for, and the offer price is the lowest price you can buy. The less frequently an ETF is traded, the larger its spread will be. You should always know what the spread is on an ETF before investing.
A great place we like to use is the London Stock Exchange's own website. Just search for the ETF and look for the bid-offer spread. You'll need to work it out as a percentage for it to mean anything, so in this case it is 0.22%. Most investors are completely oblivious to how big these spreads can be.
Another good site to find this info is Hargreaves Lansdown, and they even calculate the percentage for you. Do bear in mind that the bid-offer spread is constantly changing, but at any given time it should give you an idea of what a typical spread might be.
Essentially, when looking at ETF costs, you need to look at all the costs and not just the OCF. If we look at two almost identical ETFs, we can see that the huge OCF difference is not the full story. Do remember that the bid-offer spread is only incurred when you buy and sell, and so becomes much more of an issue if you trade frequently. The spread can, and does, change significantly at any moment, based on the market conditions at the time.
Tip number 3, dividend treatment. Many ETFs offer the choice of reinvesting the dividends or paying them out as income. We prefer income, and then we can choose to manually reinvest on our timetable, which we usually do. You cannot avoid dividend tax, unfortunately, by choosing an accumulation ETF.
Tip number 4, size matters. Assets under management. We only like to invest in ETFs with lots of assets under management, AUM. We typically look for hundreds of millions or even billions of pounds or dollars of assets under management. Anything less and it probably means that the ETF is too new and hasn't fully proved itself.
A bigger ETF also means more investor interest, which is important because at some point you will probably want to sell. To do so, you will need a willing buyer and bigger ETFs attract buyers. A small ETF will likely have a low trading volume.
Small ETFs can be closed by the ETF provider if there's not enough people interested in it. This is unlikely to be a major problem, but having experienced it ourselves, we can testify that it is a tad annoying.
Tip number 5, careful of currency. A key thing to look out for is the trading or listed currency. This is the currency in which the ETF itself is bought and sold on a particular exchange.
We always choose the ETF priced in sterling when available, because otherwise your broker will convert it using its own FX rate, and they almost always add their expensive fee to this, which is completely avoidable.
I invest in the iShares Japan ETF, ticker SJPA. The base currency is in US dollars, but as you can imagine, the stocks will mostly be operating in yen. I deliberately chose the ETF, which is priced in sterling, because it's my home currency.
The base currency, otherwise known as the fund currency, is the currency that the assets tracked by the ETF are valued in and is often US dollars. This doesn't affect your currency risk whatsoever. For example, a world ETF may have a base currency in US dollars, but if US stocks only make up 55% of the fund, then your US dollar exposure will be 55%.
In terms of your currency risk, it's the currency of the underlying securities that counts. For example, if 8% of the world ETF holds stocks operating in Japanese yen, then this isn't somehow amplified by dollar risk too. A UK investor in Japanese securities is only concerned with the yen-pound exchange rate.
Some ETFs even have a currency hedged version, which can be great for eliminating currency risk as much as possible. ETFs will normally have the term GBP hedged in their names, but always check the product's fact sheet or website to make sure. A perfect example of this is the iShares Core S&P 500 ETF GBP hedged. Hedged ETFs are very likely to come with increased fees. We prefer non-hedged ETFs and instead choose to diversify globally and accept any currency risk that may arise.
Tip number 6, watch the tracking difference. While most ETFs track the underlying index closely, some ETFs don't track them as closely as they should. A small tracking difference indicates that the ETF will follow its benchmark very closely throughout, whereas a large tracking difference indicates the opposite. The fees aren't everything. It's not what you pay, it's what you get. And for that, you should check out the fund's tracking difference.
The ETFs that we invest in are all very popular and have excellent tracking. We tend to just look at the performance of an ETF and make sure it's very closely aligned with the index. Here is the performance of the Vanguard FTSE All World ETF, and it can be seen that it clearly tracks the benchmark very well.
Tip number 7, check the UK reporting status and domicile. Most ETFs are domiciled outside of the UK, and therefore they could be treated as offshore investments for UK taxpayers and be subject to other investment taxes. One of the first things we look for when picking an ETF is its domicile, and this really does matter. Just because an ETF is listed on the London Stock Exchange is no guarantee of tax efficiency for UK investors, but in our experience, the London Stock Exchange is the best place to look for ETFs.
Thankfully, the main providers in the UK, Vanguard and iShares, have designed their ETFs with UK investors in mind. And typically, ETFs listed in London will be domiciled in either Ireland or Luxembourg. We personally only invest in those domiciled in Ireland because these benefit from the US-Ireland double taxation treaty, which reduces standard withholding tax rates on US stock dividends from 30 to 15%, whereas Luxembourg domiciled ETFs are subject to the full 30% tax rate. Other domiciles might be okay, but if we don't know or we don't understand them, we don't invest in them.
We also only invest in ETFs that have UK reporting status. If it doesn't have UK reporting status, you will end up paying expensive income tax rather than capital gains tax, which for most investors would be a terrible and costly outcome. Most ETF providers will show the reporting status and domicile on the ETF's webpage and fact sheet, as seen here on the iShares FTSE 100 ETF's key facts.
Tip number 8, where to research. It sounds like stating the obvious, but first and foremost, try Google. There's bound to be an article on the web about the best ETFs that can point you in the right direction. We ourselves have covered ETFs tirelessly on our YouTube channel and have just released a video on the best Dividend ETFs, which we'll link to below.
The next place we look is justetf.com. They have an awesome ETF screener that really helps you find that winning ETF for your portfolio.
Question of the day, what do you look for when picking ETFs? Did we miss anything? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.